Hello, this is my presentation about underwater trades and how I deal with them. So first of all, a little bit of disclaimer. This is a presentation about my trading philosophy and the rules I developed for my own purpose, my own trading. And it's just sharing my personal journey in trading and how I deal with issues. So it's not a trading advice or recommendation or any kind of professional trading advice of any kind. Just consider it as a storytelling. So the applicability, what I'm going to present is exclusively about ES and NQ only. Other instruments are not backtested for this model, and the applicability of those other instruments are unknown. NQ is used as an example in my presentation throughout, but it works for ES also equally. So what is the agenda for this? So we will discuss, who is this presentation for? Very important to understand when you read any document, who is the target audience. And what is the context? So the context here is that why do underwater trades happen, and what is my exit strategy for that? Then I talk about 5 underwater trade scenarios. That's how I classify them. Then preparing to face those underwater trades, then working out of those underwater trade situations, and some recent examples that I have shared in Twitter since I started this small tape reading Twitter account, and the summary. So the target audience, this is not for beginning traders at all. So that's very important to understand. This is for future traders who have already traded for 1 to 2 years with experience in trading ES or NQ futures. And they understand the concept of price levels very well, exit entries, etc. All those basic concepts about trading a future, the leverage, etc. Have a trading system. So they know how to, what they're looking for. They have some understanding about their position trading and position sizing, where to take profit, what is their stop strategy, how much they are willing to risk, all of those stuff. So none of this is in the scope of this presentation. It's assumed that the traders know it. A person like me who has this experience in doing that. So now let's go deeper into the context here. So when a trade does not work, or you see signs that it is not working, the best thing to do is to cut it for a small loss. Everyone knows that. So, for example, for NQ, 10 to 30 points loss is like a small change. You can quickly recover that. Maybe it will suck for a little bit of time, but then, within an hour, I'm pretty sure you'll get another setup in a normal RTH time. But this presentation is about the rest of the time when one is stuck with the trade underwater. If you're honest with yourself, you will understand that you will end up in the situation from time to time. If you do not ever end up in a situation where you are sometimes, get into this underwater scenario and you have to work out of it, then there's no need to watch the rest of this presentation. I'll give you a time back. So statistically, this small percentage of occurrences where a bad trade was not cut can cause spiraling disaster for a trader. And this is, sometimes future traders blow up their account multiple times. They have a string of very good days, and then 2 weeks they trade fantastically, and then boom, one day they do some mistake. They try to frantically get out of it, and they make a bigger mistake, and then 2 weeks of work is gone in one day or 2 days, and then it costs it's very mentally damaging for them. So I came up with my own strategy to deal with them. So my philosophy here is that acknowledge the problem, and I am a flawed trader because I'm a human and I make mistakes. So what are the kind of mistake I'm likely to make, and how do I deal with them? That's the purpose of this presentation. So let me examine why it is sometimes difficult to cut bad trades quickly. There are two reasons, two classification of reasons. Sometimes it's not easy to understand a trade is bad. And then secondly, specific to my own stop strategy. And how does that cause me to have underwater trades? So two key questions. How do you know a trade is not working? Second question, how do you manage your exit? Is the trade not working is it because of the time? Because is it not moving fast enough for you? I know that sometimes some traders, they just want to place a trade and then boom, it has to go. Otherwise, they just feel very uncomfortable and they tend to cut it. Or is it because of price? Because is it because it pierces your risk boundary? Is that the reason? These are two main categories. Consider these facts about time and price aspects. The time aspect, a major day trade move, for example, a lot of the time this happens is that in the morning there is some sell off, but it just stalled there and it is just chopping around a level, but it has not gone beyond that level. It just kind of have some little bit of peaks below that level, but it is still holding. And a lot of good moves comes out of that consolidation. And it could be a 20-point bounce on an ES, or a 50-point bounce on an NQ. So if you cut your trade too soon because it did not move fast enough for you, you miss a big move. The second is a price aspect. The often, if you put, let's say, you have a trade, ES 4170 is your level for, but whatever levels, my level, your level, volume, profile, doesn't matter. Level is a level. So it start to, look below a little bit, some three points below, 2 points below printed, but it is rejected quickly. And if you just put that as an exact threshold, you see that the price dip below, but then it recovers that very quickly, 5 to 10 minutes. So after that, and then next thing that it is like 10 points above. So these things happen a lot. So the fact is that, let's just take these three levels. So I have a profit target level, and the middle is your entry level, and below is a risk marker level. So let's just say your entry level is, 4170, and then you put 4165 as the risk marker. 50% of the time when that risk price is pierced, the price will recover back to entry level, or at least close by. So what I mean to say is that if you try to enter, at your entry level, it may poke below that risk marker, but 50% of the time, statistically, because it's very easy for me to backtest. All my levels are programmatically defined, so I can easily write a program that will and test that entry and see how many times it moved against below that next risk marker and recovered that price. So that means that what that means is that if you use hard stops, 50% of the time you will be stopped, and then the price will recover. And this, I did not want to deal with it. So my exit strategy is different, is slightly, so generally speaking, I want conviction that my trade setup has failed before I exit. I don't want to pay for unnecessary stops. Because of this principle, I did not use hard stops. I did not use hard stop because I want to avoid these unwanted stop out that happen 50% of the time. That actually has made a significant improvement in my bottom line. So if you have seen in my, in my live trade tweets, how many times do you see me taking a hard stop? Never at all. And I have a fairly very high success rate of getting out of a trade, either by profit or at a break even. So my exit method is that if a support is appeared to be breaking because of price or time, I exit within 10 to 30 points of loss, small loss. That is my plan, just like everybody else's plan. But in order for it to trigger that plan, it's not a hard stop. But I may take heat and see price goes to test the next level down, etc., before I decide that it is not working. So so a long entry not working. Take an example for that. So price stay below my support, and couple of attempts cannot get above that support. So price below support more than, so that is a price based thing. And that's the next is a time based. Price stays below support for more than 5 to 10 minutes, and then it cannot recover. So even after 5 to 10 minutes, it tries to get, but it can, barely get above it. That's my sign, because there is this constant fight. I like this analogy of, bulls and bear playing football with each other, so they get these 3 attempts to get across the next 10 yards and they could not. And now the bears get the chance and they're trying to push it further. And that's when you exit. So I have my system, you have your system, everybody has their system, but this is my system. I'm just explaining my trading strategy and the stop strategy for that. And this is why I don't take a hard stop. So example NQ, I bought yesterday's example, right? I bought 890 in the morning, 884 is the level. So I'm just giving a hypothetical example. I didn't trade this one, but price dips after 10 minutes and attempts to bounce, peak at 880 or 881. So, yesterday morning, Friday morning, NQ was at 313, 884 was support, 1 time, 2 times. By 3rd time, it started to break. And let's say that's the time I actually entered the trade. And now it went below. And the next level below is 854. And it's trying to bounce, but it can't get about 880, 881. And that's when I tried to cut it. I tried to cut it for 875 for a 15-point loss. And in between, it may have dipped to, 860, etc. So I don't really care about that dip. I can take that heat, no problem. So my exit model, but because of this reason, does not always work, because what if the price does not even come back and give me a decent exit? Sometimes price just falls through, just like a brick in water, just dips, it just goes through without giving me a bounce back and a small loss exit. And notice that I'm talking about long side, but the converse is true for the short side trade also. Couple of reasons, so this is one reason, the price action. Price just never gave me a chance to exit at a decent level. Then I am stuck with an underwater trade. That's reason number one. Reason number two is that the price did give me an underwater trade, but I'm a human. I need to click that mouse button in order to exit, but I did not. I could get a little bit of inaction, and I kind of over analyzed it, and then the chance is gone. So I lost my focus. And secondly, I have a full-time day job, and it's very easy when I'm in a busy meeting, and especially when I am the one who is running and leading that meeting. That's when most of my difficulty happens. I tried to not be in trading at that time, but sometimes I'm already in that trade, or I just decided to get in and it did not work, and then I'm not in my top form. Many reasons like that. Humans make mistakes. That's why we are humans. So now I explained, so far what I covered is that, why does, underwater trades happen? It could be a couple of reasons, because, as a factor of time or price, and depending, and in my particular case, I explained what is my exit strategy. That is to trade without a fixed stop or a hard stop. And I wait after seeing proof that the trade is not working before I try to exit at a decent loss. But sometimes it doesn't happen. So now I categorize. I have categorized this underwater situation under 5 different types of scenarios. So let's look at them. So one is that price sells below support, but it is not a trend down day. So not every day is a straight up trend down and sells 200 NQ points. That does not happen all the time, right? So it's just say that it went below support, like what happened in Friday. The support was 884, it went down to 854. So that's one type of scenario. Second is it's a major trend down day, and maybe 1 or 2 or 3 of my levels break without any bounce. It would be very, very hard pressed for you to see that more than 3 of my levels get blown through without any pause or a bounce. But so let's just say that happened. But you also have to figure in the context. So the context here is that the market is still under major support levels. So let's just say that market was ripping up, ES was ripping up, and then it established a key support. So let's say 3980, and then it went to 4025, then it went to 4065, then it went to 4125, then it went to 4150, and then establishing floor after floor after floor, higher and higher levels. So that means that you have a big stable ceiling below you, and it's a bullish market. So there are legions of people out there trying to buy any dip. This has to be in the back of your mind all the time. The third scenario is that, so that second scenario is basically, I'm saying that it's a trend down day, but there is no damage done to the bullish tape at all. The price is above the 20-day moving average, what people typically look at, and some major support levels have not been broken. So if I were to take today's example, 4150 is supposed to be a major support level, and it is still not broken. Price closed above 4170 last Friday. Then third category is that some news hit out of the blue. You have no clue it is coming, and it just drove the price down. And it is that driving that price down is a 100% telltale sign of an algorithm-driven selling. The last time it happened, and it happened to me when I was trading and holding an NQ long at I was trading 14,020 NQ at that time, waiting for 10 more points move to exit at my trade. And this news came that Biden is proposing a maximum long-term interest, not investment, what is it called? Investment tax rate up to 48%, and boom, NQ sold 200 points all the way down to 13,700s. Just like that, within 30 minutes it happened. So number 4 is that it's a multi-day structural support break, and this is a big one, because now you are, let's say, this what doesn't ever happen out of the blues. This is why the context is very important. So let's just say the price is now on on NQ. The 13,800 is gone, and now 13,600 is gone. That was the last one. And now we all know, if anybody's watching price, the last breakout happened at 12,950 just before Good Friday weekend. And then it just went to 13,150, and then it went straight up above 500 in a matter of 2 days or something, with no consolidation anywhere between. So that is what I called a major structural support break. Or in example of ES, 4110 or 4115 were tested 3 times or 4 times, and it held and bounced. If it comes back there one more time, chances are that 80% that it will break. And now if it breaks that level, there is like a kind of a vacuum under for 100 points below. So that is what I mean by a multi-day structural support break kind of underwater scenario. And then the last one is this random move within a consolidation chop time. So the market moved up or down after opening, and then it came to 11, and then the move fizzles out. So let's just say it's sold first, but it's fizzling out. And then between 11:30 and 1:30 p.m., there is this a little bit back and forth. The price basically stays between two of my minor levels, or between a major level and a minor level, and it just keeps chopping there, or between 2 or 3 maximum levels, but there is no strong force behind it. And then what is the risk of me going underwater too much more? So these are the 5 categories that I have identified that I can get inside a underwater situation, and the strategy for deal with them could be different. So it's very important for me to classify them. So now, preparing to face underwater trades. I prepare myself by asking some basic questions so that I can understand how deep underwater I can get, because I think of everything as a math problem. So if you have a sized account, and if you're positioned accordingly, sometimes you will understand if you think like this, and if you have a gauge of what is the max that I can get under. Is it 20 ES points, or is it 200 ES points? You may freak out, but you will understand that 200 ES points is $10,000 on one contract, or if you're trading micros, it's much less, or if you trade 10 contracts, is much higher, $100,000. So don't let the dollar value figure freak you out. What is important is that what is the ratio of your capital. So that's why I'm saying this is not for beginner traders. So any trader who is experienced, have a trading system, has an inherent understanding of their position size and risk they're willing to take. So this goes into all of that. So then if you think, then take a bigger picture, then you will understand that, okay, yeah, I can deal with that, because I have ways to get out of it, and I can take that hit. And then if you do that, then you will not be afraid of a situation that you're going to get in, because you are prepared for to deal with it. It's like you are going into a battle, and no general prepares their army for a strategy where you're always winning and conquering. A good general will always have strategies for what are the cases under which I will be under attack, how deep casualty I will take, what kind of injury rate I could take, and then prepare for it. So that's my point here. So what kind of day is this? Is this a trend day, or is it an inside day? Inside day was, just a chop between last day's high and low, or it's a two-sided day. We can go, some big trend up, like move up, it's like a pendulum swing, but then it can come down also, a lot of opportunities there, but it is not a major structural support break or anything like that. So that's what you are trying to understand, so that's very, very important for a trader to understand what are the odds, what is the kind of day this is likely to be, or what is happening here. Then where's the market at? What is the context here? So is it a price above some major support level, or is it a bearish sentiment right now? Because that will have a lot of impact on how much, are you likely to get underwater for 50 NQ points or 300 NQ points? So my review, so I review my levels. This is identified like a ladder level, right? This is why I don't look at anything else. My system is very, very simple. I like to keep things very simple. So I have this opening, that a pivot point that is 3915. I call it the key bull bear line, and then I have a 939 and 884. Those are the boundaries of that. So above that, above 939, then I'm very likely to buy that because the price is moving up. unless it stalls. So that is that flow of the price, and then see where it ends the support or the immediate move down. If 915 is, after RTH opens, it tests 915, it can get over it. This is what happened yesterday, right? The price tried to get above it, but it only spent just 35 minutes above 915, or not even that, and then it just dropped below 915 and it started to sell all the way, about 90 points. So you get that flow there. So that's my main concept. So and then I also attached to that, where is the RTH open? So it gives me that idea about, where is the price at, where is the flow at, and then I understand and I ask myself, is today the day it is likely to, sell below major levels? So the 3-digit levels are what I call minor levels. The 5-digit, the full 13,805, that was one of the major levels. So is it likely to sell more than 805 and all the way to 666? That's like, 300 NQ points, if it goes, or more than that. Or if it is 805 and I try to do an 884 trade, that's only like 80 points maximum that I can go underwater. So if it was at the beginning of the week when price was at 14,000 and above, etc., then the chances of selling it through all the way three major levels down is pretty unlikely. But as the price structure, the ceiling or the floor start to break, then the tendency of selling more and more will increase. So that context is very important to understand. The next is that in the bull market we are in, unless price is under major sell-off, like I just explained, it's unlikely to have more than 2 major levels sell. So that means that you already know, in this case, it's very unlikely that we will not go below, 13,666, in this time frame. So then how do I deal with it? Once you understand it, then there are ways to make money also out of it while you're stuck on a bad trade. So all of this should give an answer to the clue, how much underwater this trade is likely to get in. So now I will talk about working out of the underwater trades based on this assumption. So there are some rules that I follow. And some of the rules is a topic for another presentation by itself. So do not put max trade capacity into a single entry. I don't put my entire position size into a single trade. And that is a key thing that I made. That's a key assumption that I made. So I used to put, I have, let's say I have the capability to trade, 2 contracts at a time. I used to go 2 contracts at the all in, but now I don't do that. And then secondly, a hung trade does not prevent continuation of my day trade. So that if I'm hung on a trade, I can keep going on with other trades. Then ability to withstand a single deep underwater position, even NQ 1000 NQ point. That's an extreme. I don't think I will ever face 1000 NQ points underwater, because I would be repairing that trade much before. But I am just saying, this is the kind of assumptions that I have put in, and I can withstand it if I have to, and I will still come under, and I'll be still okay to continue to trade with my account. My account will not be blown. That is like that is some of the deeper tests that I have put against myself on my account. Then must not hold more than 1 position underwater. Excuse me, I had to pause for a second. How do I mute? Then finally must not hold more than one position unit. I missed the word one. So the must not hold more than 1 position unit underwater. And sometimes I made a mistake, like last week, I ended up holding 2 units underwater. This is one of the important criteria that I have. Now next one is so the repair strategy. So there are 4 strategies that I have. One is the dollar cost average that everybody knows about. Second, I call it scalp at the next consolidation. It's just my term that I came up with to explain it. Third strategy, a very important strategy at the same time, is just do nothing. You'll be surprised how much time, how often you can get out of it by doing nothing. And the last one is park the hung trade, but then continue to trade to raise the cost basis of that trade and exit at a decent place. So I'll go into each one of them in a step by step. So the dollar cost average step, so let's say you have 884 trade that you entered, and then you waited, and you wait for where the market is selling and where it is stopping, and you understand by reading the price that okay, 829 is where it is stabilizing, because 854 it continued to trade. And this is again another reason I am saying that this presentation is not for beginner traders. It needs some experience to read the price and understand that 854 did not pause that sell. It took all the way to 829. So two levels. And then you added 829, then your average is somewhere around 854, and you get out. I don't think it's mathematically correct average, but it is like roughly probably somewhere there. So that is the dollar cost average. It could be maybe another level below, and I have more units of power to add, so I can get out of it by dollar cost averaging. So everybody knows about what dollar cost averaging is. The next one is a little bit slightly different, and this happens quite a lot actually. So wait for a consolidation stage. So let's say you enter 884, and it is going there, but it did not bounce back. So you entered 805, but it is not going all the way to 804 or anything to dollar cost average, because it just fizzles out. Then I changed my strategy. Then I tried to get out for like a 20 points at a time, because what the market is doing is consolidating. It's very important to understand that it consolidates, and you have to wait till the price is just stabilizing. So let's say they're given at least 45 to 1 hour, the price did not make any more lows below 805, and it is likely to consolidate, maybe one or two small dips below, but it is never selling below that. That's when it's consolidating. And then I can have like 4 times make 20 point scalps around 805 to 830 area, and then suddenly I make up the entire trade that I was under, and I get out. That's what I call scalp at the next consolidation and exit. Then the next one is park and raise the cost average, and this is very useful, and this is the only way out sometimes when you are at underwater position, because a major support break or a major breakout happen, and now the price structure entirely changed. So let's just say that NQ was trading last week 13,800 to 14,000 range, but all of a sudden this week, coming week, the price structure is changing, and 805 did a hard break, and now which went into 600 to 700 range. So then what happened is that I parked that trade, and then I forgo my day trading profit. But instead I fund my trade that is underwater. I immediately go because I can understand that this is starting to sell now. So I took a couple of short trades around 805 and drove it down to 700s. And then also I did some long trades, whatever it is. I traded it with that part of the market, and I raised 50 points NQ or 100 points NQ, and then I applied it to my cost basis. So suddenly my 884 entry is now cost basis at to 800, and then the support is at 666. I didn't do anything because price is still going down. By tomorrow or the day after is starting to bounce back, and 805 is still a major resistance level, so I exited at 775. So bottom line, I did not panic. I just got a much decent exit, and I forgo 1 day of day trading profit. But what it helped me is that I did this kind of major breakout happens maybe once in a month, so that means that all the other times I'm not trading without fear. I want to press the market, show me the money, show me that the support is broken before I just unnecessarily get out of my long trades. That's what I'm trying to do here. So the do nothing strategy is also very important. You'll be surprised how often you'll get a break even exit just by waiting it out. Especially true underwater longs, because longs side you get a free exit a lot of the time because of the bull market that we are in for the last few years. Then waiting even for 2-3 days or even a week. Sometimes people are in day traders are so impatient that they want instant karma. That doesn't always happen. So if you just give it 2-3 days, and as long as your position size is correct and your day trading continues, and you just simply park that trade aside, then you can you'll just watch and the market bounce back and you get a free exit. So some of the behavioral changes that I had to make for this is that do not panic. Number one rule. You can see that I go underwater trade and I just post about it and I just hang out and then do other things. I just go back about my life. And the main reason I did that, I did a significant change in my position sizing and I look for much lesser profit overall. So I'm not trying to make huge amount of money from a single day trade, or 1 day trade. My expectation is much less and I have so much firepower left. Then wait and assess the situation after, go underwater. Then I try to go through that, five scenarios of underwater trades, and I try to understand what kind of underwater situation is this. Do I do a dollar cost average? Do I do nothing? Do I fund my trade, or do I just do a scalp at the consolidation area and make enough profit, and then then exit the bad trade and make some extra on that in that process. What I don't do is that what I should not do. I mean, sometimes I still kind of make a mess out of it because again, I'm a human after all. Is that you went underwater and now you're franticing. You're in a panic mode because you think that you're gonna ruin your account so much. You don't want to, or you don't want to give up all your profit that you made. So you kind of starting to switch back and forth. Oh, it's selling. Okay, now I change my position, and and then that is not working, and then you switch back again. So instead of being 100-point underwater position that you could have easily repaired, now you are under 200 points underwater, and then you're causing more damage to myself. And I've done it so many times and I have blown my account, and this is why I came up with this model. So recent examples. So there are recent examples where I had positions go deep underwater. When this original breakout happens on 11 I made a typing mistake there. It's not 11, 13,150 on that Good Friday weekend. And then it broke out to 13,300. My 80% statistics, I trust my statistics in the sense that if something works 80% of the time, don't try to just, work around it. Just go with that flow because that is easier. So I showed it 13,000, so that somewhere in that area, thinking that I will get that 11,150 back again, but it did not. It was a true unprecedented breakout not unprecedented, but that happens once in 3 months kind of breakout. And it broke out to 13,500. So then I raised my cost to 13,380 and see if it will come back there. And it still did not come back, and it broke out even to 13,800, and then I raised my cost basis to 13,665. So I lost about 2-3 days of a day trading profit out of it, but I did a break-even exit without damaging my account. The account doesn't get overdrawn or anything like that. And but anyway, this type of stuff happened once in three months. So in my mind, I'm okay to do that, because that means that the rest of the time my strategy is giving me much fewer unnecessary losses, unnecessary stop loss. So that was one way that I did it. And even that week I still had a fantastic profit because I was also trading on the long side of the rest of the time. Then another example, I was short 13,985 just on Thursday, and the price broke out to 14,050, but I exited at 14,116 at a pullback. So because I just waited for the pullback that was for what it could happen, that is slightly above that breakout point. So just patience, just wait. Then another the most recent example was the 13,835. I shorted again, thinking that it is market was trending down from 14,000s, but price bounced hard to 39.80, and I went 150 points underwater. I raised the cost to 13.7. Again, a lot of typing mistakes here. I raised the cost to 13,872, and the price came back just by that evening, and I exited at half at that raise price, and then the other half I actually held for actually making profit on that trade, because I understand the price structure. This is why I said the market context is very important, because what I am seeing is that the price broke some key levels and it's very likely to retest that loss again overnight. So the summary is that why this method? By waiting for confirmation of setup failures, I avoid false stops, because I want market to show me that I am wrong and not just jump into that conclusion and then just unnecessarily take a trade stop. Then as a percentage of trade, this drastically raised my win percentage. And if you follow my daily trade post that I make, you will see that then a true market breakdown or breakout happens only once in few months. So where I could take a deep underwater straight, so it could eventually take 100 or 200 point loss maximum, and then I had to work out of it. But this happens like very rarely. So I don't try to anticipate every trade is going to be like that. So it also helped me prepare for it. And normally I would not go more than 100 points underwater, which is very easily repaired. It's not like that I want all my trades to go to 300 points. And I'm just trying to say that I am prepared for that kind of scenarios. But normally by 100 points underwater, I am already starting to repair that trade. So that is the end of the presentation. I'm kind of curious to hear, any feedback that people may have about it, because I don't hear normally in FinTwit people talking about the actual trading aspect of it, because everybody posts levels, and there's a lot of good traders out there that post their levels, but much less is talked about how to get underwater, how to get out of bad situation, because bad situation do happen. So I hope this was helpful. Thank you.